22 states, one-third of America's GDP, already in recession. Not next year, not next quarter, right now. While Wall Street celebrates GDP growth and low unemployment, half of the United States is quietly bleeding. Foreclosure filings surging 19% year over year. Home insurance companies abandoning entire states. And middle-class families who thought they were safe, discovering they're just one paycheck away from losing everything. This isn't fear-mongering. This is data from Moody's Analytics, Atom, and state auditors who are raising red flags that almost nobody is hearing. Today, we're revealing which 5 states will hit the wall first when this economic pressure cooker finally explodes. And if you live in one of them, what you're about to discover could save your financial future. Mark Zandi, chief economist at Moody's Analytics, told Fortune magazine something shocking in October 2025. Lower and middle-income Americans are hanging on by their fingertips financially. They have jobs, but wage growth has stalled. They have debt piling up from student loans, car payments, and mortgages. And they have almost zero savings to fall back on if anything goes wrong. According to Moody's exclusive analysis, 22 states are seeing their economies actively contract. 13 more are treading water, barely staying afloat. Only 16 states are experiencing actual growth. The national numbers look fine because economic giants like California, Texas, and New York are still holding steady. But Zandi warned that if either California or New York tips into recession, the entire national economy goes down with them. We're walking a tightrope, and 5 states are about to fall off first. Let's break them down, starting with number 5. New Jersey, the pension time bomb. New Jersey's problem isn't just one crisis. It's 3 catastrophes colliding at once. First, the state's pension system is a financial black hole. According to the Manhattan Institute, New Jersey's pension funding gap grows by $10 million every single day. By late 2025, the state's unfunded pension liabilities hover somewhere between $92 billion and $190 billion, depending on which economist you ask. Even after Governor Phil Murphy made full pension payments for the first time in decades, experts warn the system is still on track to fail within 10 years. Teachers, police officers, firefighters, and healthcare workers who dedicated their entire careers to public service are staring at a future where promised benefits might simply vanish. That's not a scare tactic. That's math. Second, property taxes in New Jersey are the highest in America. The average homeowner now pays $9,800 per year just in property taxes alone. For retirees living on fixed incomes, that's nearly their entire annual pension payment going straight to the state. Many seniors are being forced to choose between staying in homes they've owned for 40 years or abandoning them to move somewhere more affordable. Margaret, a 71-year-old widow from Essex County, told local media she's selling her house after 38 years. Not because she wants to, because she literally cannot afford to stay. Her pension was cut, her property taxes increased again, and her savings are almost gone. She's not alone. Thousands of New Jersey families are making the same agonizing decision right now. Third, the state's emergency reserve fund is dangerously thin. According to Pew Charitable Trusts, if a recession hits, New Jersey's reserve could only sustain government operations for 2 days. Not 2 weeks, 2 days. Compare that to states like Wyoming or Alaska, which have reserves capable of funding operations for months, and you begin to see how fragile New Jersey's position really is. Foreclosure rates are climbing. According to Atom's October 2025 report, foreclosure activity is up 19% nationally year over year. New Jersey is feeling that pressure intensely, especially in cities like Newark and Camden, where economic instability is hitting hardest. Commercial real estate is collapsing too. Office vacancy rates in Jersey City have climbed above 19%. Buildings that were once considered premium assets are now sitting empty, unable to attract tenants or buyers. When both residential and commercial real estate are crashing simultaneously, it's not a correction, it's a collapse, and New Jersey is running out of time to stop it. State number 4, California, the giant with cracks in its foundation. California is the 4th largest economy in the world. If it were a country, it would outrank most of Europe, but size doesn't equal stability. And right now, California is showing cracks that could bring the entire nation down with it. In October 2025, Governor Gavin Newsom confirmed California is facing a $12 billion budget shortfall. Just 12 months earlier, the state was celebrating a record surplus. What changed? Corporate tax revenues collapsed. Silicon Valley, once the unstoppable engine of California's economy, has seen revenues drop 21% over the past 2 years. Venture capital funding has dried up. Startups are shutting down. Stock valuations are tumbling. And as a result, the state government is losing billions in expected tax income. Newsom admitted publicly that if state revenues drop another 5%, California will be forced to cut core services including health care, public safety, and transportation. That's not a political statement. That's a budget reality. Meanwhile, housing affordability has reached levels that are simply unsustainable for most residents. To afford a median-priced home in California, a household needs an annual income of approximately $237,000. The state's actual median income is $96,500. That 2.5 times gap means home ownership is now mathematically impossible for the majority of California families. Even people who already own homes are struggling. The average cost of home ownership in California, including mortgage, insurance, property taxes, and maintenance, now exceeds $5,900 per month. For retirees on fixed incomes, that's a financial death sentence. One unexpected medical bill, one insurance rate hike, one property tax increase, and they're forced to sell. And in a market where office vacancy rates have hit 28% in San Francisco and 22% in Los Angeles, who exactly is buying? Homelessness in California has exploded past 181,000 people. That's not just a humanitarian crisis. It's a symptom of an economic system that's breaking down. These aren't all people with addiction or mental health issues. Many are working families who simply got priced out. Natural disasters are compounding the problem. Wildfires, floods, and droughts drove emergency response costs up 18% in 2024 alone. Insurance companies are pulling out of high-risk areas. Homeowners who've lived in the same house for decades are suddenly unable to get coverage at any price. Mark Zandi from Moody's said California is currently treading water. If it tips into recession, it takes the entire national economy down. That's how critical California's situation is. This isn't just a state problem. It's a national threat. State number 3, Nevada. The casino economy. Running on empty, Nevada built its entire economy on one thing: tourism. Las Vegas, Reno, Lake Tahoe. People flying in from around the world to gamble, attend conventions, see shows, and spend money. But that model only works when people have disposable income. And right now, they don't. Tourism revenue in Nevada dropped 7% over the first 3 quarters of 2025. Convention bookings are down. Hotel occupancy rates are falling. And the state budget is short nearly $200 million as a direct result. Governor Joe Lombardo admitted the state will need to make cuts, even if they're unpleasant. But for retirees and fixed-income residents, those cuts aren't just unpleasant. They're devastating. Public services are shrinking. Healthcare access is getting worse. Neighborhood safety is declining. And housing, the supposed safe haven for wealth preservation, is collapsing. Nevada officially has the worst foreclosure rate in America. According to ATTOM's October 2025 data, 1 in every 2,747 housing units in Nevada has a foreclosure filing. In Las Vegas specifically, the rate is even worse. 1 in every 1,114 homes. Imagine living on a street where every few blocks, another house is being repossessed. That's the reality in Las Vegas right now. Home prices have officially dropped 2.2%, but real estate analysts warn the actual decline could hit 10 to 12% over the next year as distressed properties flood the market. It's not just people with mortgages who are panicking. Fully paid-off homeowners, most of them retirees, are watching their property values freefall. That's not just lost wealth. That's retirement security evaporating. And it gets worse. The cost of living in Nevada is surging while asset values collapse. Food prices are 12% higher than the national average. Electricity costs have jumped 15% over 18 months. Home insurance premiums have climbed 28% in just 2 years. Some insurance companies have stopped issuing new policies entirely in Clark County, which includes Las Vegas. Even if you manage to keep your home, the cost to protect it is now out of reach for many families. Nevada was supposed to be a retirement paradise. Low taxes, warm weather, affordable living. But that promise is crumbling. Seniors who moved to Nevada 10 or 15 years ago are now asking themselves a painful question. Do I have to start over again at 70? State number 2. Florida. The Sunshine State. Turning dark. Florida was the American dream for retirees. Warm weather, no state income tax, beautiful beaches, a relaxed lifestyle. But by November 2025, that dream has turned into a financial nightmare for hundreds of thousands of families. Let's start with the insurance crisis. After Hurricane Ian caused $112 billion in damages in 2022, Florida's home insurance industry collapsed. By mid-2025, more than 10 major insurance companies, including Farmers and Allstate, have pulled out of the state entirely. Homeowners now pay an average of over $6,000 per year for insurance. That's 3 times the national average. And for retirees on fixed pensions, that's an expense they simply cannot absorb. Congressman Jared Moskowitz reintroduced federal legislation in November 2025 trying to reduce insurance costs, but even he admits the situation is dire. Florida now leads the entire nation in home insurance non-renewal rates. Families are receiving letters in the mail telling them their coverage is being canceled, not because they filed claims, simply because insurance companies no longer want the risk. Homeowners associations across Florida have raised fees 15 to 25% in 1 year to cover skyrocketing insurance and maintenance costs. For condo owners, especially retirees, this is a financial breaking point. Many are paying more in HOA fees and insurance than they originally paid for their entire mortgage. The housing market itself is in free fall. According to ATTOM, Florida has the second highest foreclosure rate in the nation. 1 in every 1,829 housing units has a foreclosure filing. 9 of the 15 most overvalued housing markets in America are in Florida. Cities like Tampa, Cape Coral, and North Port, where home prices exceed real value by 30 to 40%. A severe correction is inevitable. With a median household income of $67,900 and average home prices around $417,000, the math doesn't work. At 7% mortgage rates, a family needs to earn nearly $120,000 annually just to qualify for a loan. The gap between reality and affordability has frozen the market. Transactions are plummeting. Confidence is evaporating, and the people getting crushed are retirees who thought they were safe. David Schroeder, a 74-year-old retiree from Melbourne, told media he can no longer afford $7,200 per year, just for the illusion of safety. His insurance company refused to renew his policy. His HOA fees tripled. And now he's self-insuring, which means if a hurricane hits, he loses everything. David's story is becoming typical across Florida. Hundreds of nursing homes have shut down, unable to survive skyrocketing costs for insurance, utilities, and staffing. Senior services are collapsing just as the senior population grows. Tourism, Florida's economic engine, is sputtering. Visitor numbers dropped 6% in 2024. Hotel occupancy in Orlando, Tampa, and Miami hit the lowest levels since 2017. Tens of thousands of service workers, many of them over 50, and working part-time after retirement, have lost their jobs. Florida was supposed to be the place where you finish your life comfortably. Now, it's becoming the place where retirees are forced to leave, just to survive. State number 1. Maryland. Maryland isn't collapsing because of hurricanes or housing bubbles or pension crises. Maryland is collapsing because its entire economy is built on something it cannot control: the federal government. In October 2025, more than 4,000 federal employees were laid off during the first week of the government shutdown. Projections warn that number could exceed 10,000 if budget deadlock continues. For most of America, that's a headline. For Maryland, it's an economic earthquake. Maryland has the highest concentration of federal workers in the country. Montgomery County, Prince George's County, and the corridor between Washington, D.C. and Baltimore are packed with families whose livelihoods depend entirely on federal spending. Government pensions, federal contracts, support services. When agencies freeze hiring/contracts and cut operations, Maryland doesn't just catch a cold. It goes into systemic shock. A report from WIPR in August 2025 issued a chilling warning. If Congress cuts just 10% of federal spending, Maryland would immediately lose 3% of its GDP. That means tens of thousands of families, many of them retired civil servants, would see their income vanish while health care deteriorates and cost of living keeps climbing. Baltimore, Maryland's industrial and commercial heart, is losing its pulse. Office vacancy rates have climbed above 22%, the highest in a decade. Rental prices have fallen below $19 per square foot, a historic low. Montgomery County, once the pride of Maryland's biotech sector, is facing mass layoffs as venture capital investment evaporated by nearly 40% year over year. The housing market is struggling too. Median home prices sit around $430,000, far out of reach for a median household income of $98,400. With mortgage rates near 7%, thousands of families are spending more than 40% of their income just to keep a roof over their heads. Foreclosures jumped 29% in 1 year, with more than 95 homes repossessed in Baltimore alone. Moody's downgraded Maryland's credit outlook, citing heavy dependence on federal activity. The state's reserve fund stands at just $2.9 billion, a sum that could be drained in less than a year if a deep recession hits. Unfunded pension liabilities have reached nearly $25 billion, a ticking time bomb threatening the state budget for the next decade. Retirees, once Maryland's backbone of stability, are now caught in a financial vice: soaring living costs, tightening health care coverage, growing fears that state benefits won't provide a livable income. Maryland federal contractor layoffs increased sharply in early 2025 as federal spending cuts accelerated. Families who thought their government jobs provided lifetime security are discovering that security was an illusion. Maryland isn't collapsing from a single storm. It's eroding slowly, steadily, as the pillars of its economy crack one by one. Federal funding, government jobs, high-tech industries, all weakening simultaneously. And when the foundation gives way, everything built on top comes crashing down. So there they are, the 5 states standing at the edge of economic collapse. New Jersey, with its 2-day reserve fund and pension crisis. California, with its $12 billion deficit and unaffordable housing. Nevada, with the nation's worst foreclosure rate and a tourism economy running dry. Florida, with an insurance industry in freefall and retirees fleeing by the thousands. And Maryland, held hostage by federal spending cuts it cannot control. This isn't doom and gloom. This is data. Hard numbers from Moody's Analytics, Atom, state auditors, and economic reports that Wall Street doesn't want you reading too closely. Because if you're retired, living on a fixed income, or holding property in any of these states, this isn't abstract theory. This is your financial future. Check your family finances. Reevaluate where you live. Ask yourself honestly, is this state economically safe? And if the answer is no, make your move before it's too late. Which state do you think will collapse first? Are you already feeling these changes where you live? Share your story in the comments. Your experience might help thousands of others avoid the same financial disaster. Don't forget to like, subscribe, and turn on notifications, because in the next video we're revealing the hidden states that are quietly surviving this recession. The places where smart investors are moving their money right now. Protecting your assets means protecting your peace of mind. Don't wait for the crash to start looking for a way out.